Before we start, we need to understand certain things. When there is an impairment what? Reduces the cost, carrying amount of an asset. Impairment because it brought down to recoverable amount. But it has nothing to do with the tax base. Income tax nothing to do with impairment. That means what? There will be effect in accounting profit. You will be charging reduced amount of depreciation because carrying amount is getting less. If the period is the same, you will be charging lesser amount of depreciation, but nothing to do with calculation of taxable profit. Just take this example I am telling you. Profit before depreciation, see 100 per year. There are 5 years, you see, profit is 100, 100, no problem. One asset acquired at 100, its life is 4 years. That means they will be charging 25 rupees per year because depreciation is under SLM, straight line method. 100 rupees cost, 25 they charge because life is 4 years. So 1 by 4 is 25%. So they will be charging 25 depreciation per year. For tax it is 20%. Income tax allows 20 rupees for 5 years. So what is the current tax? You see, current tax for all 5 years is how much? 100 rupees is my profit before depreciation. They allow 20 rupees reduction for 5 years. 40% is tax raise. So every year I need to pay my current tax is 32. You see, for all these 5 years. There is no variation. 100 rupees cost, they allow 20% for 5 years. So 20 rupees every year. That means 100 minus 20 is 80. Income tax that is given, you see, 40%. So 32 is the current tax. Okay? Now, first year profit 100%. Life is 4 years. That means for the first year they charge 1/4. 25% is 1/4, life 4 years. They charge 25 rupees as depreciation. Okay? Now you see, there is no difference between, there is difference between depreciation that is recognized and that is allowed. How much is allowed? Allowed 20 rupees. How much recognized? 25. Difference is 5. 5 into 40% is 2. See here, 2 rupees deferred tax income. Okay? Year 1. What is the carrying amount? What's the tax base? Carrying amount is 75. 100 minus 25. Tax base is 80. 100 minus 20. So 5 rupees is what? Deductible temporary difference. That creates one deferred tax asset. This into 40%. That means CU2. You can check up here. Okay. Carrying amount 75, tax base 80, 5 rupees is deductible temporary difference into tax rate. CU is 2, deferred tax asset. What is the entry? Deferred tax asset to deferred tax income. How much? CU2, CU2. This will go where? Tax expense. And this is carried forward to balance sheet. In the balance sheet at the end of year 1, there will be a deferred tax item of CU2. Next year, so you can see also here 100 rupees, 25 depreciation, accounting profit is 25, 75, and tax expenses 32 minus 2, 30, 45. So as I told you earlier, there is a relationship between accounting profit and tax expense. If income tax that is 40%, tax expense has to be 40% of accounting profit. You see, tax expense 30 is 40% of 75. That is the accounting profit. Now, second year. Second year, what happens? We have charged 25 depreciation. Recoverable amount, they say 40. So, what is the carrying amount? They say 40. Tax base 60. 20 rupees is what? Deductible temporary difference. In the usual case, carrying amount is generally 50. $100 minus 25 minus 20 is 50. But they say it is 40. 10 rupees is what? This 10 rupees is impairment. See here, 10 rupees is impairment. I repeat, carrying amount 100 minus 25, 25, 50. But they say recovered amount is 40. 10 rupees is what? 10 rupees is impairment. Clear? So tax base is how much? 60, because we have charged 20 plus 20. So what is this? This is your deductible temporary difference. Tax base is more than the carrying amount. How much it is? 8. No, sorry, 20. This is 20. Into 40%, that is CU8. There has to be deferred tax asset of CU8. But we already have how much? 2 rupees. So further 6 rupees has to be created. Carrying amount should have been 50, but they say recovered amount is 40. 10 rupees is impairment reversal. Sorry, it is impairment. So, carrying amount is 40 given, tax base 60, deductible temporary 20, deferred tax asset should be CU8. Already we have how much? 2. So further deferred tax to be created 6. Same entry, deferred tax asset to deferred tax income, CU6, CU6. This is tax expense. See here, and this is balance sheet. So balance sheet 2 rupees created earlier. here and 2 rupees now. So balance at the end of year 2 is 8. Now, third year. Here also same thing for second year. Accounting profit your 100, depreciation 25, 10 rupees impairment 35, 65 total, tax expense 26, 26 is 40% of 65, tax expense is 40% of accounting profit. So total profit for the period is 39. Third year 100 rupees, but you see 40 rupees is the carrying amount at the end of year 2. Life is 4 years. That means remaining 2 years, 3 and 4, we can charge depreciation 20 and 20. Because 40 rupees is the carrying amount. So what is the carrying amount at the end of year 3? Carrying amount how much? 20. 40 is the carrying amount at the end of year 2 given, minus 20, that is 20. And tax base is for 3 years 60 rupees charge, so it is 40. Clear? I repeat, carrying amount end of year 2 it is 40, 20 charge depreciation, so remaining carrying amount is 20. Tax base for 3 years 20 rupees into 360, 160 is 40. So 20 is what? Deductible temporary deferment, that is deferred tax asset, 40%. We need to create one deferred tax asset of CU8, but you already have CU8 as deferred tax assets, so nothing to be done. You see, nothing has been done. Year 4, it is the same 100 rupees, 20 is depreciation, 80 accounting profit, you can check up. Tax expense 32 is 40% of 80. Year 4, what is the carrying amount? Carrying amount is 0. 40 here, 20, 20 gone. Carrying amount is 0 at the end of 4th year, because life is 4 years, you see. Tax base is 20. They allow 20 rupees per day for 5 years. So at the end of year 4, 80 gone, 20 remains. So 20 is what? Tax base is more than the carrying, that is deductible temporary difference. Same thing, 40%, and this is CU8. We already have 8. First year we have created 6, second year 6. So nothing to do, you see, nothing has been done. So 100 rupees profit, 20 depreciation, accounting profit is 80, tax expense 32, 32 is 40% of 80. So profit for the period is 48. Last year my carrying amount is already 0. In the 4th year, last year tax base is also 0. They have allowed 20 rupees tax deduction for depreciation. So when these two are 0, none of them can exist. So the deferred tax asset of 8, that is reversed. So for 32 current tax plus 8, 40, you can check up. 100 is my profit, no depreciation allowance, already availed of 100 is accounting profit. Tax expense is 40, that is also 40% of 100. So my profit for the period is 60.